You are leaving money on the table every single month. Most people park their savings in a high yield savings account, feel pretty good about themselves, and it involves something that sounds old, boring, and like something your grandfather would have done. Government bonds. You are going to understand exactly why moving a specific portion of your savings into treasury bonds could mean more money in your pocket, a lower tax bill, and a clearer path to buying that car or putting a down payment on a house. First, I want to set something straight before we go any further because this is probably the most important thing I am going to say in this entire video. The money we are talking about today is not your emergency fund. It is the 3 to 6 months of living expenses you keep accessible at all times for when life decides to punch you in the face. Job loss, medical bills, car breaks down, whatever. That money stays liquid, it stays accessible, and it should stay in something like a high-yield savings account where you can get to it within a day or two. What we are talking about today is a completely separate bucket of money. This is your goal-oriented savings, money you are setting aside for something specific, something you are planning for, something that is maybe 6 months to a few years away. That is the money we are optimizing today. Because I know some of you are already thinking this sounds complicated. It is not. When you buy a government bond, specifically a United States Treasury security, you are essentially lending money to the federal government. They borrow your money for a set period of time, and in return, they pay you interest on a regular basis. When that period ends, you get your original money back. That is it. You lend money, you earn interest, you get your money back at the end. Simple. And because you are lending money to the United States federal government, the credit risk is about as close to zero as you can possibly get. This is one of the most important distinctions between bonds and other investment options. Credit risk is the risk that whoever you lent money to cannot pay you back. With Treasury securities, that risk is essentially non-existent. The United States government has never defaulted on its debt obligations. Never. You are not gambling on a company staying afloat. You are not hoping a startup makes it. You are not crossing your fingers that some random bank stays solvent. You are lending to the most creditworthy borrower on the planet. Now let us talk about the interest rates, because this is where things start to get really interesting. Right now, Treasury yields are genuinely competitive. We are talking about rates that can match, or in many cases beat, what you would find at even the best high-yield savings accounts out there. But here is the thing people miss. The comparison is not just about the headline interest rate number. You have to think about what you are actually keeping after everything is said and done. And that brings us to what I think is the single biggest advantage of Treasury bonds that almost no one talks about enough: the tax treatment. When you earn interest in a high-yield savings account, that interest is taxable at the higher federal level, and it is also taxable at the state and local level. So if you live in California or New York or any other state with a significant income tax, the government is taking a bite out of your savings interest from multiple directions. Treasury interest is different. Treasury interest is exempt from state and local taxes. You still pay federal income tax, but your state and city cannot touch it. Think about what that actually means for you. If you live in a state with no income tax, like Texas or Florida, this advantage is smaller, though still present. But if you live somewhere with a high state income tax, we are talking potentially saving a meaningful percentage of your earnings just by choosing the right vehicle for your money. For someone in a high tax state earning thousands of dollars a year in interest, this difference is not trivial. This is real money that stays in your pocket instead of going to your state government. Imagine two people. One puts their savings in a high-yield savings account, earning a solid interest rate. The other puts their savings in treasury bonds, earning a comparable rate. The person with the high-yield savings account pays federal tax, state tax, and potentially local tax on every dollar of interest they earn. The person with the Treasury bonds pays only federal tax. At the end of the year, the Treasury bond holder has kept more of their money, even if the two accounts had the exact same interest rate on paper. In many states, this tax advantage can effectively make your Treasury yield feel meaningfully higher than an equivalent high-yield savings account rate once you run the numbers after tax. This is why bonds become especially attractive the higher your state income tax rate is. Now, I want to be fair here and talk about the real trade-off, because I am not going to sit here and pretend bonds are perfect in every situation. There is a genuine downside, and it is important. Liquidity, access to your money. This is where high-yield savings accounts have a clear advantage. With a high-yield savings account, your money is generally accessible within 1 to 2 business days. You request a transfer and the money shows up in your checking account pretty quickly. With Treasury bonds, the situation is a bit more nuanced. If you hold your bond to maturity, meaning you wait until the agreed-upon end date, you get every dollar you put in back plus all the interest you earned. Clean, simple, predictable. But if you need to access that money before the bond matures, you have to sell it on the secondary market. And here's where people get surprised. Selling early does not guarantee you get back exactly what you put in. Here is a real example. So you understand exactly how this works. Let us say you put $10,000 into a Treasury bond. You have every intention of holding it to maturity. But life happens. 6 months in, you need that money earlier than expected. You go to sell. Depending on what has happened with interest rates since you bought that bond, you might only get back $9,800, maybe less, maybe a little more. But the point is, it is not guaranteed to be the full $10,000. The value of a bond on the secondary market fluctuates based on current interest rate conditions. If interest rates have gone up since you bought your bond is now less attractive to buyers because they can get a better rate elsewhere, so the price drops below what you paid. If interest rates have gone down, your bond is actually worth more than you paid. But you cannot predict which way this will go. This is why the money you put into Treasury bonds should be money you are genuinely comfortable leaving alone until the maturity date. If there is any real chance you might need it before then, the high-yield savings account is the better choice for that specific pool of money. This is exactly why I said at the beginning that this strategy works best for goal-oriented savings with a clear timeline. If you are saving aggressively and you have a rough timeline of when you want to buy, aligning your bond maturity with your purchase timeline is a smart, disciplined way to grow that money without taking on market risk or worrying about volatility. You know your number on day one. You put in the money. You earn the interest. You know what you are walking away with at the end. That predictability is incredibly valuable when you are planning for something as big as a home purchase. And that actually brings me to another huge advantage of bonds that I have not fully highlighted yet. Predictable income. With a high-yield savings account, the interest rate is variable. The bank can and does change it whenever they feel like it. You might open an account today at a great rate, and 3 months from now, that rate has dropped significantly because the Federal Reserve changed course or the bank decided to change its margins. With a Treasury bond, you lock in your rate on the day you buy. Whatever rate you agreed to is the rate you get for the entire life of that bond. For someone who is goal-oriented, who is trying to hit a specific savings target by a specific date, that certainty is genuinely powerful. You can do the math today and know almost exactly what your balance will be when you need the money. You can also access Treasury securities through most major brokerage accounts if you already have one set up. It is not nearly as complicated as it might sound. High-yield savings accounts are also better for your emergency fund itself. The flexibility and liquidity there are non-negotiable. But Treasury bonds win on tax efficiency, especially in high-tax states. You have your emergency fund in a high-yield savings account, fully accessible, not touched, sitting there for true emergencies only. Then you have a separate account entirely, your goal savings, money with a purpose, and a timeline. If that goal is far enough away and you are confident you will not need the money before the bond matures, treasury bonds are a genuinely strong option that can earn you competitive interest, save you money on state taxes, and give you complete certainty about what you will have when you need it. If the timeline is uncertain, or you think there is a real chance you might need early access, then maybe you keep that portion in a high-yield savings account where you can get to it without penalty. If this video helped you think differently about how you are storing your savings, do me a favor and hit that like button, because it genuinely helps more people find this content and make smarter decisions with their money. Subscribe if you are not already, because we put out videos like this regularly, and every single one is designed to help you build a stronger financial life. Drop a comment below and let me know what you are currently saving for, whether it is a car, a house, or something else entirely. I read every single comment, and I would love to hear where you are in your journey.